Hello and welcome to Beacon Pointe's Foundations of Finance course. Today kicks off our first class of the series. We'll cover key financial terms, the basics of macroeconomics, and major global and market events like the Great Financial Crisis and the COVID-19 pandemic, and how these continue to shape the economy and impact investors like yourself. My name is McKenna. I'm a marketing associate for Beacon Pointe, and I'm excited to introduce today's professor, the creator of our Foundations of Finance course, partner and managing director Graham Pierce. Graham has a passion for teaching. He's also served as an adjunct professor at the UC Irvine's Paul Merage School of Business, where he taught the Wealth Management MBA course. Graham has been with Beacon Pointe for nearly 20 years, leading our private wealth advisory group in Newport Beach, California. Before that, he worked as a trader in Argentina, covering Latin America, focused funds across the US and Europe, and became fluent in Spanish along the way. Before we get started, if you have any questions during this pre-recorded session, feel free to email us at info@beaconpointe.com with the subject line Foundations of Finance Class 1 questions, and we'll follow up with the answers. That is it for housekeeping. Graham, feel free to take it away.
Thank you, McKenna. Good afternoon or morning, whatever time you are watching this. Thank you for spending part of your day with us. I hope you like this first class. It's actually my favorite one, and it's why I'm teaching it. But the purpose, as kind of McKenna alluded to earlier, the purpose of this course is really, we put this together a while ago, but with it designed to help young adults or any adults better navigate the financial world, whether you're in finance as a career or not. Having some understanding of important financial concepts will help make you make more informed decisions going forward. So these are kind of a lot of things that we, as longtime professionals in finance, wished we knew, kind of coming out of college. And so hopefully you'll find the series of lectures and lessons valuable. This first one is talking about the two big crises that had a big effect on our economy, and more importantly, the way we've dealt with these crises will continue to impact how we live, both from an economic perspective, but also as a cultural one. We're going to talk about the Great Financial Crisis of 2008 and the pandemic-related Great Shutdown of 2020. But before we do that, I want to get into really some important concepts of economics. And what I found, we're going to go through a video created by a renowned investor, heavily followed, very successful gentleman named Ray Dalio, who founded Bridgewater Associates, a hedge fund investment firm that has had tremendous success. And he alludes kind of this video, he puts together kind of a framework calling it how the economic machine works. It's a kind of a stick figure video, but the reason why I want you to see this, and we're going to go through it, is I've probably used this. It's one of the most important tools one can have when it comes to understanding basic economics. And again, whether you're in this industry in finance, totally dedicated, or whether you just are wanting to make more informed decisions related to your own finances and the economy, this will prove really valuable. So I'll encourage you to save this video. We're going to go through it pretty quickly because we still want to uncover and discuss how these two crises, what happened and what they mean. But it's important to better understand the crises, how they unfolded, and how we dealt with them. To better understand how kind of basic economics from this well-known finance leader, finance investor, Ray Dalio. So I'm going to take you through the video now, and I'm going to start and stop one or two times. We won't spend a lot of time on it, but I will on things that I don't find as important for purposes of understanding these crises. But we'll head into it, and there are a couple things I want you to pay attention to when he talks about what credit is, and its importance, and then when he talks about a recession, what happens in a recession, and how governments and central banks deal with it, versus a deleveraging, which, just to think of, a deleveraging is kind of a more severe recession, which is harder to solve. I'll give you some hints there. And again, all this relates to our analysis of the two great crises that we've dealt with. So without further ado, here we go with Ray Dalio.
How the economic machine works in 30 minutes. The economy works like a simple machine, but many people don't understand it, or they don't agree on how it works, and this has led to a lot of needless economic suffering. I feel a deep sense of responsibility to share my simple but practical economic template. Though it's unconventional, it has helped me to anticipate and to sidestep the global financial crisis, and it has worked well for me for over 30 years. Let's begin. Though the economy might seem complex, it works in a simple mechanical way. It's made up of a few simple parts and a lot of simple transactions that are repeated over and over again a zillion times. These transactions are above all else driven by human nature, and they create three main forces that drive the economy. Number one, productivity growth. Number two, the short-term debt cycle. And number three, the long-term debt cycle. We'll look at these three forces and how laying them on top of each other creates a good template for tracking economic movements and figuring out what's happening now. Let's start with the simplest part of the economy, transactions. An economy is simply the sum of the transactions that make it up, and a transaction is a very simple thing. You make transactions all the time. Every time you buy something, you create a transaction. Each transaction consists of a buyer exchanging money or credit with a seller for goods, services, or financial assets. Credit spends just like money, so adding together the money spent and the amount of credit spent, you can know the total spending. The total amount of spending drives the economy. If you divide the amount spent by the quantity sold, you get the price. And that's it. That's a transaction. It's the building block of the economic machine. All cycles and all forces in an economy are driven by transactions. So if we can understand transactions, we can understand the whole economy. A market consists of all the buyers and all the sellers making transactions for the same thing. For example, there is a wheat market, a car market, a stock market, and markets for millions of things. An economy consists of all of the transactions in all of its markets. If you add up the total spending and the total quantity sold in all of the markets, you have everything you need to know to understand the economy. It's just that simple. People, businesses, banks, and governments all engage in transactions the way I just described, exchanging money and credit for goods, services, and financial assets. The biggest buyer and seller is the government, which consists of two important parts: a central government that collects taxes and spends money, and a central bank, which is different from other buyers and sellers because it controls the amount of money and credit in the economy. It does this by influencing interest rates and printing new money. For these reasons, as we'll see, the central bank is an important player in the flow of credit.
Okay, so here we go. Credit. Pay attention to what credit and its importance, because this has everything to do with how we dealt with crises and how we get into problems.
I want you to pay attention to credit. Credit is the most important part of the economy and probably the least understood. It's the most important part because it's the biggest and most volatile part. Just like buyers and sellers go to the market to make transactions, so do lenders and borrowers. Lenders usually want to make their money into more money, and borrowers usually want to buy something they can't afford, like a house or a car, or they want to invest in something like starting a business. Credit can help both lenders and borrowers get what they want. Borrowers promise to repay the amount they borrow, called principal, plus an additional amount called interest. When interest rates are high, there is less borrowing because it's expensive. When interest rates are low, borrowing increases because it's cheaper. When borrowers promise to repay and lenders believe them, credit is created. Any two people can agree to create credit out of thin air. That seems simple enough, but credit is tricky because it has different names. As soon as credit is created, it immediately turns into debt. Debt is both an asset to the lender and a liability to the borrower. In the future, when the borrower repays the loan plus interest, the asset and the liability disappear and the transaction is settled. So why is credit so important? Because when a borrower receives credit, he is able to increase his spending. And remember, spending drives the economy. This is because one person's spending is another person's income. Think about it. Every dollar you spend, someone else earns, and every dollar you earn, someone else has spent. So when you spend more, someone else earns more. When someone's income rises, it makes lenders more willing to lend him money because now he's more worthy of credit. A credit-worthy borrower has two things: the ability to repay and collateral. Having a lot of income in relation to his debt gives him the ability to repay. In the event that he can't repay, he has valuable assets to use as collateral that can be sold. This makes lenders feel comfortable lending him money. So increased income allows increased borrowing, which allows increased spending. And since one person's spending is another person's income, this leads to more increased borrowing, and so on. This self-reinforcing pattern leads to economic growth and is why we have cycles. In a transaction, you have to give something in order to get something, and how much you get depends on how much you produce. Over time, we learn, and that accumulated knowledge raises our living standards. We call this productivity growth. Those who are inventive and hardworking raise their productivity and their living standards faster than those who are complacent and lazy. But that isn't necessarily true over the short run. Productivity matters most in the long run, but credit matters most in the short run. This is because productivity growth doesn't fluctuate much, so it's not a big driver of economic swings. Debt is, because it allows us to consume more than we produce when we acquire it, and it forces us to consume less than we produce when we have to pay it back. Debt swings occur in two big cycles.
So I'm going to reiterate that. Credit matters more than productivity growth in the short run because credit allows us to consume more than we produce when we take on that debt. So it allows more than we produce when we acquire it, and it forces us to consume less than we produce in the future because we need to pay it back. So it sets off the beginning of a transaction when you take credit or you borrow, because you're borrowing ahead of time because you don't have the money right then to pay for something. But then that also implies that in the future you are paying less or investing less in order to repay the debt. And that's how the transaction is settled.
Cycles. One takes about 5 to 8 years, and the other takes about 75 to 100 years. While most people feel the swings, they typically don't see them as cycles because they see them too up close, day by day, week by week. In this chapter, we're going to step back and look at these three big forces and how they interact to make up our experiences. As mentioned, swings around the line are not due to how much innovation or hard work there is. They're primarily due to how much credit there is. Let's for a second imagine an economy without credit. In this economy, the only way I can increase my spending is to increase my income, which requires me to be more productive and do more work. Increased productivity is the only way for growth. Since my spending is another person's income, the economy grows every time I or anyone else is more productive. If we follow the transactions and play this out, we see a progression like the productivity growth line. But because we borrow, we have cycles. This isn't due to any laws or regulations. It's due to human nature and the way that credit works. Think of borrowing as simply a way of pulling spending forward. In order to buy something you can't afford, you need to spend more than you make. To do this, you essentially need to borrow from your future self. In doing so, you create a time in the future that you need to spend less than you make in order to pay it back. It very quickly resembles a cycle. Basically, anytime you borrow, you create a cycle. This is as true for an individual as it is for the economy. This is why understanding credit is so important, because it sets into motion a mechanical, predictable series of events that will happen in the future. This makes credit different from money. Money is what you settle transactions with. When you buy a beer from a bartender with cash, the transaction is settled immediately. But when you buy a beer with credit, it's like starting a bar tab. You're saying you promise to pay in the future. Together, you and the bartender create an asset and a liability. You just created credit out of thin air. It's not until you pay the bar tab later that the asset and the liability disappear, the debt goes away, and the transaction is settled. The reality is that most of what people call money is actually credit. The total amount of credit in the United States is about $50 trillion, and the total amount of money is only about $3 trillion.
So the total amount of credit is 50 trillion. The total amount of money is 3 trillion. Don't sit on those numbers because that was a while ago. But what's important is how much bigger and more powerful credit is, in this case, 50 trillion, than money is, which is 3 trillion. And again, money is different than credit because money settles the transactions immediately. Credit sets into motion a transaction that will be settled in the future. And credit is more than 15 times more than money in this case. So it has a much bigger effect on the economy and the health of the economy. You go right back a bit there. There you go.
And the total amount of money is only about $3 trillion. Remember, in an economy without credit, the only way to increase your spending is to produce more. But in an economy with credit, you can also increase your spending by borrowing. As a result, an economy with credit has more spending and allows incomes to rise faster than productivity over the short run, but not over the long run. Now, don't get me wrong. Credit isn't necessarily something bad that just causes cycles. It's bad when it finances overconsumption that can't be paid back. However, it's good when it efficiently allocates resources and produces income so you can pay back the debt. For example, if you borrow money to buy a big TV, it doesn't generate income for you to pay back the debt. But if you borrow money to, say, buy a tractor, and that tractor lets you harvest more crops and earn more money, then you can pay back your debt and improve your living standards. In an economy with credit, we can follow the transactions and see how credit creates growth. Let me give you an example. Suppose you earn $100,000 a year and have no debt. You are creditworthy enough to borrow $10,000, say on a credit card. So you can spend $110,000 even though you only earn $100,000. Since your spending is another person's income, someone is earning $110,000. The person earning $110,000 with no debt can borrow $11,000, so he can spend $121,000, even though he has only earned $110,000. His spending is another person's income, and by following the transactions, we can begin to see how this process works in a self-reinforcing pattern. But remember, borrowing creates cycles, and if the cycle goes up, it eventually needs to come down. This leads us into the short-term debt cycle. As economic activity increases, we see an expansion, the first phase of the short-term debt cycle. Spending continues to increase and prices start to rise. This happens because the increase in spending is fueled by credit, which can be created instantly out of thin air.
And this is how the bubble was created in the Great Financial Crisis, which we're going to get into.
When the amount of spending and incomes go faster than the production of goods, prices rise. When prices rise, we call this inflation. The central bank doesn't want too much inflation because it causes problems. Seeing prices rise, it raises interest rates. With higher interest rates, fewer people can afford to borrow money, and the cost of existing debts rises. Think about this as the monthly payments on your credit card going up. Because people borrow less and have higher debt repayments, they have less money left over to spend. So spending slows. And since one person's spending is another person's income, incomes drop, and so on and so forth. When people spend less, prices go down. We call this deflation. Economic activity decreases, and we have a recession.
So a recession is economic activity decreasing. And the central bank, by effectively raising and lowering interest rates, can increase or lower the cost of borrowing. And so if prices are getting too high in the economy and they want to cool the economy down, they make credit harder to acquire. So by making it more expensive, by raising interest rates, making that interest rate on which you're borrowing that money higher. And what that does, it slows down borrowing, which in turn slows down investing and consumption, and which in turn affects prices decrease. And then as the whole economy slows down, you're in a recession.
If the recession becomes too severe and inflation is no longer a problem, the central bank will lower interest rates to cause everything to pick up again. With low interest rates, debt repayments are reduced and borrowing and spending pick up, and we see another expansion. As you can see, the economy.
So in a recession, it's easy. Recessions can be solved by increasing or decreasing the price of money, i.e. increase or decreasing interest rates. And that then gets borrowing. If prices are down and there's a recession, you lower the price of money, make it easier to acquire credit. The more credit that's available, the more people can invest, and the economy picks up again. So a recession is much easier to solve. We're going to get into what a deleveraging is and even a depression. Think of those kind of synonymously, but that's much harder to solve, and we'll get to that right now.
Money works like a machine. In the short-term debt cycle, spending is constrained only by the willingness of lenders and borrowers to provide and receive credit. When credit is easily available, there's an economic expansion. When credit isn't easily available, there's a recession. And note that this cycle is controlled primarily by the central bank. The short-term debt cycle typically lasts 5 to 8 years and happens over and over again for decades. But notice that the bottom and top of each cycle finish with more growth than the previous cycle and with more debt. Why? Because people push it. They have an inclination to borrow and spend more instead of paying back debt. It's human nature. Because of this, over long periods of time, debts rise faster than incomes, creating the long-term debt cycle. Despite people becoming more indebted, lenders even more freely extend credit. Why? Because everyone thinks things are going great. People are just focused on what's been happening lately. And what's been happening lately? Incomes have been rising. Asset values are going up. The stock market roars. It's a boom. It pays to buy goods, services, and financial assets with borrowed money. When people do a lot of that, we call it a bubble. So even though debts have been growing, incomes have been growing nearly as fast to offset them. Let's call the ratio of debt to income the debt burden. So long as incomes continue to rise, the debt burden stays manageable. At the same time, asset values soar. People borrow huge amounts of money to buy assets as investments, causing their prices to rise even higher. People feel well.
Okay, I'm going to repeat just these last two sentences or three sentences. And when they talk about asset prices, think of real estate, because this is exactly what got us into the great financial crisis and the bubble that was built and then finally popped.
Same time, asset values soar. People borrow huge amounts of money to buy assets as investments, causing their prices to rise even higher. People feel wealthy. So even with the accumulation of lots of debt, rising incomes and asset values help borrowers remain creditworthy for a long time. But this obviously cannot continue forever. And it doesn't. Over decades, debt burdens slowly increase, creating larger and larger debt repayments. At some point, debt repayments start growing faster than incomes, forcing people to cut back on their spending. And since one person's spending is another person's income, incomes begin to go down, which makes people less creditworthy, causing borrowing to go down. Debt repayments continue to rise, which makes spending drop even further, and the cycle reverses itself. This is the long-term debt peak. Debt burdens have simply become too big. For the United States, Europe, and much of the rest of the world, this happened in 2008. It happened for the same reason it happened in Japan in 1989 and in the United States back in 1929. Now the economy begins deleveraging. In a deleveraging, people cut spending, incomes fall, credit disappears, asset prices drop, banks get squeezed, the stock market crashes, social tensions rise, and the whole thing starts to feed on itself the other way. As incomes fall and debt repayments rise, borrowers get squeezed. No longer creditworthy, credit dries up, and borrowers can no longer borrow enough money to make their debt repayments. Scrambling to fill this hole, borrowers are forced to sell assets. The rush to sell assets floods the market at the same time as spending falls. This is when the stock market collapses, the real estate market tanks, and banks get into trouble. As asset prices drop, the value of the collateral borrowers can put up drops. This makes borrowers even less creditworthy. People feel poor. Credit rapidly disappears. Less spending, less income, less wealth, less credit, less borrowing, and so on. It's a vicious cycle. This appears similar to a recession, but the difference here is that interest rates can't be lowered to save the day. In a recession, lowering interest rates works to stimulate borrowing. However, in a deleveraging, lowering interest rates doesn't work because interest rates are already low and soon hit 0%. So the stimulation ends.
So lowering the cost to borrow or the cost to access credit all the way to zero doesn't do anything in a deleveraging. This is a more severe recession. This is getting to a depression almost. And in a deleveraging, the reason why lowering interest rates, lowering the cost to access credit has no effect on getting people to borrow is because in a deleveraging, those people that would normally borrow are too busy selling assets and trying to pay down the too much debt that they've already accumulated. So it doesn't matter if you bring the price to borrow new money down to zero. They're too busy. The economy's too busy. People are too busy paying back and selling assets to reduce their existing debt. So they're in debt reduction mode, not debt accumulation mode. So lowering the price to access new debt or new credit has zero effect. And now when this happens, you'll see then the government has to step in. And again, this happens in the great financial crisis.
Interest rates in the United States hit 0% during the deleveraging of the 1930s and again in 2008. The difference between a recession and a deleveraging is that in a deleveraging, borrowers' debt burdens have simply gotten too big and can't be relieved by lowering interest rates. Lenders realize that debts have become too large to ever be fully paid back. Borrowers have lost their ability to repay and their collateral has lost value. They feel crippled by the debt. They don't even want more. Lenders stop lending, borrowers stop borrowing. Think of the economy as being not creditworthy, just like an individual. So what do you do about a deleveraging? The problem is debt burdens are too high and they must come down. There are 4 ways this can happen. 1, people, businesses, and governments cut their spending. 2, debts are reduced through defaults and restructurings. 3, wealth is redistributed from the haves to the have-nots. And finally, 4, the central bank prints new money. These 4 ways have happened in every deleveraging in modern history. Usually, spending is cut first. As we just saw, people, businesses, and even governments tighten their belts and cut their spending so that they can pay down their debt. This is often referred to as austerity. When borrowers stop taking on new debts and start paying down old debts, you might expect the debt burden to decrease. But the opposite happens. Because spending is cut, and one man's spending is another man's income, it causes incomes to fall. They fall faster than debts are repaid, and the debt burden actually gets worse. As we've seen, this cut in spending is deflationary and painful. Businesses are forced to cut costs, which means less jobs and higher unemployment. This leads to the next step. Debts must be reduced. Many borrowers find themselves unable to repay their loans, and a borrower's debts are a lender's assets. When a borrower doesn't repay the bank, people get nervous that the bank won't be able to repay them, so they rush to withdraw their money from the bank.
Oops.
Banks get squeezed, and people, businesses, and banks default on their debts.
Okay, so this is how the great financial crisis began to unfold, how our banking crisis. These banks had all of these loans out to lenders, to borrowers. These banks had loans to these borrowers that were backed by collateral, which was the underlying real estate. But you saw this vicious cycle that ensued. Now these loans, their borrowers, these banks' borrowers weren't able to pay back, and the collateral is worth that they take over because they can't pay back is worth much less than what it was before, because everyone's selling everything to reduce to pay down their debts. And then people who's now the bank's assets, he said a couple times, somebody's debt is another person's asset. What they mean by that is someone's debt, a borrower from a bank, he has a liability. If he borrows $100 from a bank, let's say $1 million from a bank, he borrows $1 million, he has a liability of $1 million owed to the bank. The bank had lent that money out and has an asset of a loan receivable from this person of $1 million. But when that person can't pay back that $1 million, so the net asset on that bank's books, the net worth of that bank, that asset is no longer worth $1 million. It's worth whatever it is less, much less. And so now that bank has less financial strength. He's got lower equity, lower net worth, the bank itself. And so they become an entity that can get itself into trouble. And it does that because people that deposit and lend money to that bank through deposits, when you deposit money into a bank, you have a savings account, you deposit money into that savings account at that bank, you're effectively lending money to that bank. And that bank in turn lends it out at a higher rate than it's paying you to borrow your money in a savings account. But when a bank is borrowing your money, a savings account, and you feel that that bank is not as creditworthy because it's losing a lot of its net worth through loan losses elsewhere, then you want to pull your loan, your savings. And that's how banks fail. And this is what happened in the great financial crisis.
This severe economic contraction is a depression. A big part of a depression is people discovering much of what they thought was their wealth isn't really there. Let's go back to the bar. When you bought a beer and put it on a bar tab, you promised to repay the bartender. Your promise became an asset of the bartender. But if you break your promise, if you don't pay him back and essentially default on your bar tab, then the asset he has isn't really worth anything. It has basically disappeared. Many lenders don't want their assets to disappear and agree to debt restructuring. Debt restructuring means lenders get paid back less, or get paid back over a longer time frame, or at a lower interest rate than was first agreed. Somehow, a contract is broken in a way that reduces debt. Lenders would rather have a little of something than all of nothing. Even though debt disappears, debt restructuring causes income and asset values to disappear faster, so the debt burden continues to get worse. Like cutting spending, debt reduction is also painful and deflationary. All of this impacts the central government because lower incomes and less employment means the government collects fewer taxes. At the same time, it needs to increase its spending because unemployment has risen. Many of the unemployed have inadequate savings and need financial support from the government. Additionally, governments create stimulus plans and increase their spending to make up for the decrease in the economy. Governments' budget deficits explode in the deleveraging because they spend more than they earn in taxes. This is what's happening when you hear about the budget deficit on the news. To fund their deficits, governments need to either raise taxes or borrow money. But with incomes falling and so many unemployed, who is the money going to come from? The rich. Since governments need more money and since wealth is heavily concentrated in the hands of a small percentage of the people, governments naturally raise taxes on the wealthy, which facilitates a redistribution of wealth in the economy from the haves to the have-nots. The have-nots who are suffering begin to resent the wealthy haves. The wealthy haves, being squeezed by the weak economy, falling asset prices, and higher taxes, begin to resent the have-nots. If the depression continues, social disorder can break out. Not only do tensions rise within countries, they can rise between countries, especially debtor and creditor countries. This situation can lead to political change that can sometimes be extreme. In the 1930s, this led to Hitler coming to power, war in Europe, and depression in the United States. Pressure to do something to end the depression increases. Remember, most of what people thought was money was actually credit. So when credit disappears, people don't have enough money. People are desperate for money, and you remember who can print money? The central bank can. Having already lowered its interest rates to nearly zero, it's forced to print money. Unlike cutting spending, debt reduction, and wealth redistribution, printing money is inflationary and stimulative. Inevitably, the central bank prints new money out of thin air and uses it to buy financial assets and government bonds. It happened in the United States during the Great Depression, and again in 2008 when the United States Central Bank, the Federal Reserve, printed over $2 trillion. Other central banks around the world that could printed a lot of money too. By buying financial assets with this money, it helps drive up asset prices, which makes people more creditworthy. However, this only helps those who own financial assets. You see, the central bank can print money, but it can only buy financial assets. The central government, on the other hand, can buy goods and services and put money in the hands of the people, but it can't print money. So in order to stimulate the economy, the two must cooperate. By buying government bonds, the central bank essentially lends money to the government, allowing it to run a deficit and increase spending on goods and services through its stimulus programs and unemployment benefits. This increases people's income as well as the government's debt. However, it will lower the economy's total debt burden. This is a very risky time. Policymakers need to balance the four ways that debt burdens come down. The deflationary ways need to balance with the inflationary ways in order to maintain stability. If balanced correctly, there can be a beautiful deleveraging. You see, a deleveraging can be ugly or it can be beautiful. How can a deleveraging be beautiful? Even though a deleveraging is a difficult situation, handling a difficult situation in the best possible way is beautiful. A lot more beautiful than the debt-fueled, unbalanced excesses of the leveraging phase. In a beautiful deleveraging, debts decline relative to income, real economic growth is positive, and inflation isn't a problem. It is achieved by having the right balance. The right balance requires a certain mix of cutting spending, reducing debt, transferring wealth, and printing money so that economic and social stability can be maintained. People ask if printing money will raise inflation. It won't if it offsets falling credit. Remember, spending is what matters. A dollar of spending paid for with money has the same effect on price as a dollar of spending paid for with credit. By printing money, the central bank can make up for the disappearance of credit with an increase in the amount of money. In order to turn things around, the central bank needs to not only pump up income growth, but get the rate of income growth higher than the rate of interest on the accumulated debt. So what do I mean by that? Basically, income needs to grow faster than debt grows. For example, Let's assume that a country going through a deleveraging has a debt-to-income ratio of 100%. That means that the amount of debt it has is the same as the amount of income the entire country makes in a year. Now think about the interest rate on that debt. Let's say it's 2%. If debt is growing at 2% because of that interest rate, and income is only growing at around 1%, you will never reduce the debt burden. You need to print enough money to get the rate of income growth above the rate of interest. However, printing money could easily be abused because it's so easy to do and people prefer it to the alternatives. The key is to avoid printing too much money and causing unacceptably high inflation the way Germany did during its deleveraging in the 1920s. If policymakers achieve the right balance, a deleveraging isn't so dramatic. Growth is slow, but debt burdens go down. That's a beautiful deleveraging. When incomes begin to rise, borrowers begin to appear more creditworthy. And when borrowers appear more creditworthy, lenders begin to lend money again. Debt burdens finally begin to fall. Able to borrow money, people can spend more. Eventually, the economy begins to grow again, leading to the reflation phase of a long-term debt cycle. Though the deleveraging process can be horrible if handled badly, if handled well, it will eventually fix the problem. It takes roughly a decade or more for debt burdens to fall and economic activity to get back to normal, hence the term lost decade. In closing, of course, the economy is a little bit more complicated than this template suggests. However, laying the short-term debt cycle on top of the long-term debt cycle, and then laying both of them on top of the productivity growth line, gives a reasonably good template for seeing where we've been, where we are now, and where we're probably headed. So, in summary, there are 3 rules of thumb that I'd like you to take away from this. First, don't have debt rise faster than income, because your debt burdens will eventually crush you. Second, don't have income rise faster than productivity, because you'll eventually become uncompetitive. And third, do all that you can to raise your productivity, because in the long run, that's what matters most. This is simple advice for you, and it's simple advice for policymakers. You might be surprised, but most people, including most policymakers, don't pay enough attention to this. This template has worked for me, and I hope it will work for you. Thank you.
Thanks, Ray. So I'm going to put this a little bit back so I can talk. One of the last things that Ray says in his 3 lessons.
And third, do all that you can to raise your productivity, because in the long run, that's what matters most. This is simple advice for you, and it's simple advice for policymakers.
So Ray Dalio says, in the 3rd lesson, do all that you can to raise productivity. And that's one thing about the United States is its ability to borrow as a country versus other countries in the world. A big part of why it's so easy for the United States to borrow money relative to other countries, and why our US dollar, despite the scuttlebutt you hear more recently about whether the dollar's in more trouble than it hasn't been in the past, but the reason why the dollar is kind of a gold standard and why people trade in other economies, countries, individuals view dollar as a safe haven relative to other currencies is because of the US's economy, because of our ability to increase productivity. We're increasing productivity constantly because of how the United States innovates. And our capitalist system rewards those. The system here, capitalism rewards those that can produce the best widget or the best product or service. And so the incentives are huge in a capitalist society. But equally important is not just the incentives that capitalism produces for someone to innovate and make the best of whatever it is, but also that we have law, patent law, for example, that protects those innovations. And people know that, or innovators know that if they can produce the best widget, that they will be protected and their benefits will be protected through these types of benefits. De facto will be protected via law. But it's our ability to innovate and the incentive system that we have and the protection that those that do innovate receive is why there's so much strength in belief in our dollar. Now, that's Ray Dalio. Please, again, keep this video for yourselves. Go over it again and again and again. I can tell you that every time I still listen to it, it's been, like I said earlier, probably 30, 40 times I've listened to watch this. There's always one nugget or connection or kind of miniature light bulb that goes off. And I found it incredibly helpful and useful in understanding other parts of the economy. So please keep that, save that, and consult it regularly. As we finish the Ray Dalio video, you'll see that hopefully you'll find the economic principles that he lays out play through the two debt crises that we review and compare, both the great financial crisis of 08 and the great shutdown of 2020 caused by the pandemic. Again, first though, and I mentioned again, I want you to understand the difference between deleveraging and a recession. Again, as Ray Dalio points out, a recession, economic activity is low, but can be stimulated by more borrowing, by easier access to credit. And easier access to credit is created by lowering the price of credit, i.e. lowering the price to borrow. And that's just the government, the central bank specifically, lowering interest rates. So by lowering interest rates, you're lowering the price to borrow, and hence making the ability to borrow easier. The easier it is to borrow, in other words, the easier it is, the more available credit is, the cheaper interest rates are, the lower interest rates are. So the cheaper credit is, and the easier it is to borrow means the more investing occurs. And then the more investing occurs, incomes from individuals and companies go up, and this virtuous cycle starts over again. So in a recession, unlike a deleveraging, greater borrowing can be stimulated by lowering interest rates, lowering the cost to borrow. So this is called monetary policy, is increasing and lowering interest rates. So it's effective. In a deleveraging, everyone is too busy it's very, very low economic activity due to everyone too busy paying down, reducing their indebtedness. And so even if you're decreasing the price to borrow, it doesn't matter. There's just no appetite to borrow because they're too busy paying down the debt they already have. And so monetary policy is not as effective and requires more fiscal policy assistance oftentimes, which is what what Ray Dalio talked about earlier. Is one example is the printing of money. There's also redistribution of wealth through taxes. But again, just want to review these two terms, deleveraging and recession, as we get into the great financial crisis. So getting into the great financial crisis, it was real estate. It was really real estate driven. Credit was easily available, and people were using that credit to borrowing money to buy homes, and home prices began to go through the roof. There are many important players in making the ability to buy a home so easy, in fact, too easy. The banks themselves, the lenders, and we'll get to this, the mortgage companies, individuals that were borrowing amounts that they shouldn't have, that really couldn't afford based on what their income levels were and their asset and how many assets they owned. But this whole bubble of real estate and real estate prices was fueled by how easy it was to borrow money to buy a home. Mortgage companies, for example, their system was they didn't pay. They didn't loan the money. They simply were paid. A loan issuance fee, but they weren't responsible for that borrower that they issued that loan to pay him back, because they took that loan from that borrower and sold it to the banks, to Wall Street. And you can see Wall Street buys, so it issues. So you go and say, I want to buy this home. Mortgage company says, yeah, they're doing everything they can to accommodate you because there's no downside for them. They can charge a fee. They make money on the fee. So the more loans and the bigger the loans that they issue, the more fees they get. And they're protected because they take these loans that they've issued and they turn around and sell packages of these loans to Wall Street. Wall Street buys them, securitizes them, puts several of these loans in a package, and then has what they call ratings agencies. You may have heard of rating agency like Moody's or Standard & Poor's, but these are companies that are paid to rate these individual loans. So from these individual mortgage loans, they're packaged into hundreds of thousands of loans and packaged into these securities. And these ratings agencies look at the credit quality of each of these loans that are packaged and say, okay, high probability of repay, low probability of repay. and then they give a rating. And these ratings are used by investors to determine whether the investment is safe enough or not to invest in. So many pension plans and institutional type governments may only buy A-rated, high quality bonds, securities that are very low risk, that pay them this rate of interest, and relied on these ratings agencies. But you'll see that in a diagram shortly that the ratings agencies were there was a conflict of interest there as well, because the ratings agencies did so much business with these banks that asked them to rate these bonds, that these banks would often pressure them to rate bonds that higher than what they probably should be rated, because the higher the bond is rated, the more investors can buy it and the more money, and the more in demand those bonds are, the more money the banks make. So banks would take when they send these packages of bonds that they bought from the mortgage company to the ratings agencies, they had them rated. Those bonds that were rated lower, those loans, those mortgage loans that were put into a package in a bond and rated lower, the banks would keep on their own books, because they know that a lot of institutional investors are not rated high enough for those investors to invest in. So they would keep those bonds and then pay themselves an interest rate on those loans that they kept. And then to protect themselves, because they're low rated, they would go and buy insurance from insurance companies like AIG. And so everyone felt that they were kind of passing the buck and felt that they were protected. Insurance companies like AIG would issue insurance that said, in the event that these loans that, let's say, Goldman Sachs has, in the event that they default, we'll cover them. They're called credit default swaps, or these securities that Goldman Sachs and all these other Wall Street banks that had kept some of these loans lower rated would buy from insurance companies like AIG. And the reason why AIG would issue this is because their thinking was, well, one may default, one loan that they have that's lower quality may fail, but we get so many premiums on so many of these other loans that the premiums we're getting, the payment, the cost, the money they're paying us to insure these bad loans all across Wall Street are much more than what it would take for us to settle one or two in the event that they default. So everyone was benefiting from asset prices going up and up, and the bubble bursts here. The market starts heading south. Any market can't go up forever. Home prices finally start stabilizing and then going down. Now the credit worthiness of the borrower is lower, because that house that he owns, even though he has debt on it, he is going down. So it means his assets, he's less credit worthy. So the less credit worthy he becomes, he has to, the more the lender is going to require that he in collateral. And if he can't afford that, then the loan gets called in, and ultimately he can't pay the loans. And so the mortgage companies are fine. It doesn't affect them, because remember, they sold those to the banks. The banks are holding a lot of these loans are getting saddled that can't be paid back, because mortgage prices are going down. The credit worthiness of the original borrower is lower. He doesn't have the assets to pay, so he has to begin selling, trying to sell any assets he can at lower values, but those values are much lower than what they still owed. So this kind of vicious cycle ensues. And now remember that what is in a credit transaction, what is when an individual borrows money, in other words, a mortgage or a home loan, he owns $1 million, let's say, on this home. The other side of that transaction, the lender that lent him that $1 million has the asset, the $1 million loan receivable, that as an asset that goes into that bank's credit worthiness and net worth. Well, when that borrower can't pay that $1 million, he can only pay 500,000, let's say. Well, the net worth of that bank, the credit worthiness of that bank itself, that asset that sits on as part of an important part of its net worth, goes from 1 million to 500,000. And remember, banks borrow money from us, from individuals and companies, and through savings accounts. And so if you're lending to someone a borrower, in this case the bank, who doesn't have the ability, whose credit worthiness has deteriorated, you begin to pull your money from that bank, because you're unsure that with lower creditworthiness, he'll be able to repay you. So this whole liquidity crisis, liquidity being money in the system, everything begins to unravel the economy. Loans begin to disappear. There's no investment. There's no employment. Companies can't borrow, so they can't hire as much. They have to fire folks, in fact, and nobody's spending. So lowering interest rates doesn't do much, again, because everyone's too busy paying down the over indebtedness they already have. So the government has to step in, which we did, in with various bailout packages. It cuts rates down, slashes rates, interest rates. That has very little effect. So it steps in and begins to try to stimulate the economy. There's an Economic Stimulus Act of 2008, and it actually sent billions of dollars in cash to families to try and help jumpstart consumption. At the same time, companies are not able to borrow like they usually are. They can't invest. Individuals that are less creditworthy are consuming less. So they're consuming products or services of other companies whose sales are decreasing. So again, this whole vicious cycle ensues, and everyone's in trouble. So the economy really comes down, slows down to a grinding halt. People are pulling their money out of the banks. The government and banks are beginning to fail. The government has to step in and try and, again, stimulate, like we're saying here, but also try and help bail out some of these banks. You've heard terms at the time, too big to fail. Some of those banks are such an important part of the economy and making sure that money and credit is, think of a bank. Another way to think of kind of the economy and the health of economy, think of an engine of a car and oil as the lubricant in the engine. It's important that you need oil in the engine. It lubricates the engine. And so the more oil in the engine, the better the car runs. The more money in the system, the more it circulates the money, the healthier an economy is. And money circulates because of borrowing and spending. Again, oil dried up in the engine. There was no oil. It wasn't circulating. Money wasn't circulating. So the economy was, the engine was failing. I ruined 2 cars because I failed to put oil in my cars as a young adult. But we don't need to get any more into that. But again, that's oil and money circulating is correlated to the health of an economy, the economic engine. So all government is stepping in. They are having to pay more unemployment because there are more unemployment claims. They're looking to bail out certain banks. They have to borrow money. The government, the US government's already a net borrower. So they're having to spend more money themselves and borrow more money to help keep the economy going and keeping some of these entities, some of these banks that are in charge of lubricating the economy alive. Again, they're keeping alive because these banks have all these loans that they thought were worth $1 million that are only worth 500,000 and have become less creditworthy. And so people are pulling their money. So government steps in. This same thing happens over in Euroland, and this is typical when there's a country that gets itself into trouble, increases its indebtedness, and gets itself into trouble. Investors naturally look at, okay, well, where is that? Could that happen in other companies or other countries? And this is called contagion. And so people begin pulling money out of European banks as well, thinking that they have a similar problem. And so Europe and a lot of the, in other areas across the world catch this cold that we first had here in the United States. Then going back to kind of the innovation of the United States, and let me just, before I get into that, let me just go back here and show you kind of the crisis that here are all the different entities. Let me find this. Here are the different entities. Here are the crises. And before I get to kind of how things began to recover and what we were doing to make that happen, here are the different entities that were involved that all had something to do with getting us into this crisis. Again, it was over indebtedness, not enough accountability, a lot of conflicted entities, conflicts of interest that had all of these entities kind of looking the other way and benefiting from things continuing to go up and without making hard decisions on whether there was too much indebtedness or not. You had the home buyer, again, who was being encouraged many times by a mortgage company that didn't have anything to lose by issuing mortgages that many of these mortgage companies knew the home buyer couldn't afford. And they could do that because they get paid a fee for the issuance fee, and the risk of being the lender here was passed along to the Wall Street banks, to whom they sold these individual loans. The Wall Street banks bought these individual loans from the mortgage companies because they could package them up in securities and get them multiple hundreds and thousands of loans into securities and get them rated by ratings agencies that they paid millions and millions of dollars a year to rate all of their securities, and so had some kind of leverage with them. The loans that weren't rated high enough and weren't suitable for a lot of these pension fund institutional investors that had, a lower credit quality, they kept. And by keeping them, because they had lower credit quality, they could pay themselves a higher interest rate, which helped their net income for the bank. And they protected themselves by buying insurance at AIG. Well, so everyone was responsible. You may hear that, oh, it was all Wall Street's problem. It wasn't. Mortgage service companies were a problem. Ratings agencies had their responsibility in this. The insurance companies that issued the insurance on the credit default swaps are partly to blame. Everyone is partly to blame, even the individual. The Fed themselves, you could argue, it was a little bit too accommodative and didn't step in earlier to better regulate what banks were doing with these loans. But we do make it out. Our what's great about our economy is the ability, because we talked about earlier, our ability to innovate. Companies, we had an exploding unemployment. It was the fastest unemployment jump in I think American history, which kind of speaks to the capitalism of the United States, that corporate America just cut expenses first, and ask questions later. And then guess what? Through technology and the innovation of the U.S. and capitalist society, our companies that had fired and terminated many of its cut all of its costs learned that they can, after remarkably little time, learn that they can produce the same amount of revenue, they can sell the same amount of goods or services with fewer resources. They became more efficient. They used technology better. They figured out better ways to innovate their own supply chains and their own processes to generate the same amount of revenue with these fewer resources, these fewer costs. So profitability as a result began to increase as we're beginning to come out of this really ugly near depression in 2011. And you have that as profitability begins to slowly increase, with the government helping as a result of stimulus and getting money, pushing money to these banks, helping these banks borrow easily to in turn lend. This virtuous cycle slow kind of shows signs of life. But a lot of people lost. A lot of people were fired and terminated. Unemployment skyrocketed, and there was this there's this animosity that began to brew between the haves and the have-nots, because importantly, the solution, and here's where the animosity began to incur, is that the solution for getting us out of avoiding a full outright depression was inflating assets, was the government stepping in and helping those banks that they couldn't afford to lose because they were too linked into our economy, into our economic system, by helping those that they felt that and inflate asset prices. So those that had assets, the ultra wealthy, many Wall Streeters that are viewed as the primary folks, by many are viewed as the ones that are most primarily responsible for the failure and then the ensuing economic near depression and the unemployment that comes with that. They all of a sudden benefited because all of this stimulus from the government and all this help help their assets. If you own assets and the government is stimulating the economy, then asset prices go up. So the animosity grew between, the anyone other than the ultra wealthy that didn't have these assets, because they didn't benefit. Not only do they don't have the assets to benefit from the stimulus solution, but they also lost their job. And many of them are looking at it like, well, you got us into this problem and you also have assets. So you caused the problem and benefited even more at the expense of we, the have-nots, or the not ultra wealthy. So there's this beginning of societal frustration, and that this kind of undercurrent that I bring this up because you'll see that began really at this time and further grew as a result of the next crisis, the great the forced shutdown as a result of the pandemic. So that brings us to the COVID crisis, the great shutdown. And governments, their first responsibility is to protect the health of their people, and also ensure their general overall long-term well-being. And you do that by having sound economic policy and measures to produce long-term fortune and improvements of lifestyles where possible within your economy. Now, the governments were stuck between a rock and a hard place here because their first and foremost duty to protect the health of their citizens, the only way they can do that because of this boogeyman pandemic where COVID, this new thing that global modern history hadn't really seen, but now they're seeing something very contagious and people dying. And they need to enact some type of social distancing measures to reduce the spread of this virus, of this pandemic. In order to do that, the social distance measures put in place had a tremendous effect on industries that relied on crowd gathering and travel. Things like airlines and hotels, huge effect because people were forced to, they weren't able to travel, they didn't want to because they didn't want to get sick. And all of these restaurants, another example of industries that got really, really hammered. And this social distancing is happening. Certain industries are getting absolutely annihilated because of the social distancing and the concerns of people, crowds spreading the virus. And at the same time, the government's trying to figure out a vaccine that can be created, approved, and distributed. So, but the effects that it has, the forced economic shutdown, the effects that it had are touch more than just someone's pocketbook or someone's balance sheet. It affects sociological and highlights sociological differences. The way the government dealt with this is it kind of shut down certain industries and then sent money directly to those industries that were most affected by these social distancing measures. And it was a lot more difficult because there were all kinds of policies and trying to get money sent to the end entity versus relying on just natural circulation of that money through the banking system, which is how most of the stimulus occurred in the great financial crisis, going directly to the end entity and relying on the government to qualify that end company, big or small, and whether they qualify for this relief is hard. There's a lot of fraud and a lot of waste that occurred with it. So it's much more challenging. The market was when you have people not traveling and not getting and not going out, not consuming, you had, the market became terrified. And you actually had a bigger crash in the short period of time through the global pandemic shutdown than you did in the great financial crisis. 34% in 33 days, this beginning in February of 2020. And then as the government figured out ways to make its social distancing and actually better yet, social integration through vaccines and other things a bit safer, how technology began to get used. Innovation, again, comes this innovation, the government's ability to innovate through Zoom, for example, what we're using right now. Business began to pick up again. Now, while business travel was down a lot, the emergence and proficiency by individuals on things like Zoom and ability to conduct business via telecommunications and video skyrocketed. And what does that do for productivity? Same thing. Productivity increases. Companies learn to generate the same amount of revenue, but on fewer resources. Profitability increases. Again, we had a spike in unemployment, similar to that of the Great Depression, actually, in 33. But you had a lot of kind of economic fits and starts that happened with the COVID-19 shutdown. But then you had, and it had some effects on how the government acted socially, which we'll get to. For example, some governments saw it as an opportunity to grab extra power, it became easier to declare a state of emergency for that, to protect, quote, its citizens, in order to quell for example, in Canada, there were trucking union protests about these vaccine mandates they wanted to put in place. And the Canadian government, under a state of emergency, said that we're going to penalize those that are protesting. They wanted access to bank accounts, things like that, going way beyond their boundaries under this kind of state of emergency mandate. And not all governments took advantage to that degree, but many did. And again, some industries recovered much quicker than others. Hotels, rental cars, restaurants, airlines, those took a bit longer than others. But also importantly, the social inequality gap began to grow. So it's one thing, I said earlier, it's one thing when a crisis highlights the disparity in balance sheet or a net worth of a have versus a have not. But now it begins to highlight one's opportunities for education. For example, when schools during COVID had to go online, they shut down and are having to go online. What single moms or single parents that don't have the ability to pay for high-speed internet access? Now their child is put at a further disadvantage because than other children at that school that do have those means. That's when the growing frustration that kind of began from just mainly a finance related one, a net worth related one in the great financial crisis, began to grow into a societal one. And you saw so many different protests and protesting so many different things and different regulations and rules that universities and companies adopted to try and equalize as much as they possibly could our societal standards, so that there isn't this disparity between the haves and have-nots. But on the government side, just like it did in the great financial crisis, it had to step in, borrow more to be able to stimulate and pay for these industries that were getting shut down. And so the overall government has more debt. There were issues with medicine to help our sick with COVID, relying on supply when the supply chains of those drugs that we need to help our citizens come from foreign countries. That's an issue. So this whole kind of relook at deglobalization and bringing things back on, and we're still seeing that now, but bringing back the most important products, making sure that even if it's at a higher cost initially, producing it for our safety of the United States, so that for our citizens, so that we can access it. And all countries looking to do that where they possibly can. But just like the great financial crisis, some great things came from this: acceleration of innovation and productivity through technology. Societal wise, business being conducted less formally. So you've got work from home, and the fact that meetings are now being conducted on Zoom versus in person brings with it means that maybe some family member is walking by in the background, and it's less formal, whether they meant to or not. It becomes kind of a less formal approach to doing business, which some things are good. Some things about that are probably great changes. Others, maybe not as much. You saw this kind of de-urbanization where, and we kind of get to it, but you see this de-urbanization where all of these resort communities blew up in demand, because with this new business, with new technology, Zoom, and the fact that business practices through Zoom are now standard and normal, one can live almost anywhere. So why not live in a place I really want to live, a resort or vacation community, if I can conduct the same amount of business through technology? So that's changed. And we're still seeing these resort communities booming everywhere as technology has become a bigger part of our communication when it comes to most business industries. You had some savings rates differences. If you kind of compare and contrast, you had a lower savings rate in the great financial crisis because everyone was borrowing, which stimulated. The great shutdown was a higher savings rate. Why? You probably guessed it. In the higher savings rate in the great shutdown, no one was spending money because no one was going anywhere. They were all sheltering in place. Different ways that the government stimulated tried to stimulate the entities, the companies and industries that need it. We talked a little bit about that earlier. GFC was a lower threat of inflation because remember, inflation is prices going higher and demand for those prices. Well, demand to borrowing was down and there was austerity. People were too busy paying down debt. They weren't demanding to buy things. So inflation, not an issue. Whereas with the Great Shutdown, you had supply chains and things that were disrupted because of shipping costs, things like that, where when you have supply chains being disrupted, distribution can only get to certain areas. And so you've got the same demand for less product, which means higher prices, and less product because supply chains were disrupted. So only product where supply chains weren't disrupted could get through. So the prices of those products that could get through went up. Again, the social, we talked about kind of the urbanization and work-life balance. No real effect in the great financial crisis, but a huge effect on deurbanization and the great shutdown. And then we talked about the growing disparities that we're still dealing with. And hopefully we're addressing those as the pendulums swing. We're better addressing those disparities. Does that mean going forward and how we deal with this in the future? Does it mean that, for example, where everyone's entitled to healthcare, should everyone have high-speed internet access as kind of the new universal healthcare? Probably so. How do we do that? Ray Dalio in his economic machine video talks about redistribution of wealth. We haven't really seen that part of the way the government solves a crisis. But it doesn't mean we won't. We may very well still see something like that. Education reform. What colleges are looking for? Colleges are prioritizing. A lot of colleges these days are prioritizing the first family member to go to college. I think that's great. They're looking at different things to kind of equal the playing field and grant the same opportunity to all folks. So there's some great benefits that are coming through these changes. Some not so great. Does requiring a vax violate our civil liberties? Something to think about. And there aren't answers to each of these. They're all a lot of debate points, but a lot of things have happened. One thing we know that the government, to bail out this country, has had to borrow more, and it has a lot more debt than it has before. And what we haven't seen yet in dealing with this increasing debt is a redistribution of wealth through taxes going higher. We haven't seen that, but at some point they're very likely going to have to. Now, innovation, we've seen innovation. If innovation continues to grow, what is AI? What is artificial intelligence going to have? What kind of effect will that have? Well, maybe AI generates so much extra productivity and so much extra revenue, corporate tax revenue, so much of corporate America using AI becomes so much more efficient, generates so many more profits. The more profits they generate, the more tax revenue to the government. The more tax revenue to the government, the more they can pay down the over indebtedness that our government has. And maybe we bail ourselves out, help reduce our debt that way. But we're going to have to reduce our debt because our government assumed an extraordinary amount of debt as a result of bailing our economies out of these two crises. It's really hard, and a lot of people smarter than I say you can never count out or go against U.S. the innovation of corporate America, and it's proven in both crises that we became even more innovative and were able to get as a result even more productive. That could bail us out, but it's likely that taxes will go up in some form in the future, because if we're borrowing more, it means we pay more of our tax revenue goes to pay the interest that we pay on what we borrowed. So again, maybe we get a deluge. You know, we make out and we're smart about the gained productivity and tax revenue, and we're using that tax revenue to more of that tax revenue to pay down our debt. That would be huge and prolong kind of the greatness of America and the improved standard of living that it wants to continue to promise its citizens. But things are more expensive, and higher education is getting harder to justify as a price for as the price for education increases. Is it worth taking out hundreds of thousands of dollars of debt? How quickly can I pay? And in many cases, it absolutely still is. But at some point, education will, higher education will need to look at itself and say, okay, how do we help make this a better trade for an incoming college student so they're not burdened with hundreds of thousands of debt when they get out? Is it worth it? Again, there aren't any no right answers to any of this, but things that you should consider. If you kind of take a step out, some great books to read if you want to learn more about the particularly the great financial crisis. I think that is a wonderful, valuable lesson on how economies boom and then inevitably bust. There's a couple of great books and a couple of movies. The Big Short and Too Big to Fail are great movies that explain a lot of this. There are some books, if you just want to learn about, and that's just kind of about the great financial crisis, but just general books. Another book about kind of the great financial crisis and booms and busts is Endgame by John Malden. It says Jim, there's John. And then just basic finance understanding, the Wall Street Journal Guide to Understanding Money and Investing is a great, helpful book just to always to have handy. That is about it. There's a few other slides here that aren't quite as important. We've included them here, but for the purpose of the presentation and lecture, you can review these on your own. And I will tell you that there are several slides that support chronologically and in detail the Ray Dalio video. So save that Ray Dalio video, consult it regularly. Again, you'll get smarter and smarter, and things will begin to click, and you realize everything is interconnected. It's really neat, but it's also more than neat. It's empowering as you're becoming more informed and astute with your investing and managing of your money. Thank you for the opportunity to spend your morning or afternoon, depending on when you're seeing this, or your evening. And if you have any questions, please don't hesitate to let my team know. Also, you are in great hands with the next classes that are coming, all real professionals and on topics that are very, very practical and you should find useful, not just this summer, but certainly well beyond. Thank you, and have a great day. Take care.
Thanks, Graham. Yeah, before we wrap up, don't forget to connect with us online. Just open your phone's camera and scan the QR code. You'll find our latest blog and article content, social media pages, Your Dollars Our Cents podcast, hosted by 2 of our Beacon Point Wealth Advisors. That's it for today's class. Thanks for joining us, and we'll see you next Wednesday, June 18th at 11 a.m. Pacific for session 2. Thanks again for tuning in.
Thank you, everybody.